Within the world's largest economy lies a ticking time bomb, set to detonate and collapse the U.S. economy. It has always been known for its economic stronghold on the world, but as of 2024, it has a devastating recession looming nearby, grappling against the threat of breaking past its debt ceiling. Join us as we unravel the complexities of the U.S. debt crisis and the status quo as it prepares for a devastating economic fallout that threatens to undo its entire $28 trillion economy. Let's start with the past, shall we? Picture this. It's 1971, and the U.S.'s political climate is charged with the Vietnam War running full throttle in the backdrop. As the war threatened to put the U.S. economy in an inflationary chokehold, Nixon decided to take drastic actions to maintain control and morale, promising growth in the employment sector, lowered inflation, and exchange rate stability. To fulfill these, Nixon proposed tax cuts, a 10% tax on all imports that were subject to duties, and a 90-day freeze on prices and wages to stimulate job growth and curb inflation. But what comes next is what's primarily responsible for the U.S.'s debt bubble today: the U.S. dollar's detachment from the gold standard in 1971. After severing the link between the U.S. dollar and gold, governments took to adopting fiat currency systems, where the value of money was not backed by a solid physical commodity like gold. As a result, central banks had the liberty to create currency without the constraint of having to back it up with gold reserves. This newfound flexibility in monetary policy enabled governments to expand credit creation virtually without limits, leading to unprecedented debt levels globally as governments, businesses, and individuals around the world capitalized on easy credit access. Fast forward 30 years, it's the early 2000s and the global economy is booming. Easy credit is flowing. Technological advancements are on their merry way. Housing prices are skyrocketing, and everyone seems to be living the American dream. But beneath the surface, the seeds of the housing debt crisis are being sown, and soon they sprout into what we know today as the 2008 recession that shook the world. It all began with irresponsible lending practices, fueled by greed and lackluster legislative regulation. Banks in the U.S. were handing out mortgages like candy, even to people who they knew did not have a strong credit score. To counteract and capitalize on the big risk of lending to individuals with weaker credit scores, banks then commissioned subprime, adjustable-rate mortgages with higher interest rates. These fluctuating loans made it riskier for borrowers if rates increased. And because of the flexibility and popularity of these standards, not only were many weak credit holders allowed to purchase pricey homes at lucrative rates, but they were also encouraged. The gimmick of easy and quick financial growth on these investments worked like a charm, fueling a massive housing bubble crisis. But when the housing bubble burst in 2008, it triggered a chain reaction that sent shockwaves through the global economy, with an estimated $2 trillion loss from the global economy, a $7.4 trillion in stock market paper losses, with the U.S. home mortgage debt shooting up to $10.5 trillion, roughly amounting to $14.1 trillion in 2022. Highest in recorded history. Not the best time to be an optimist, huh? Fast forward to the present day, and we're still feeling the aftershocks of the devastating 2008 financial crisis. As for things currently, we hate to break it to you, but things aren't looking too good right now either. The debt burden has only grown larger. As of February 2024, the U.S. public debt towers at a behemothing $34.47 trillion US dollars, fueled by years of deficit spending, quantitative easing, and low interest rates. Corporate debt continues to soar, and household debt remains a significant concern. Let's try and break this down. First off, let's take a look at how supremely high interest rates have prompted the Federal Reserve's decision to halt rate increments. Ever since the COVID-19 pandemic prompted heavy inflation, the Federal Reserve initiated a series of interest rate hikes, raising its benchmark rate 11 times within a year and a half to mitigate the rapid increase in prices. Despite a slowdown in inflation, which dropped from over 9% to 3.2%, the Fed has not yet signaled a readiness to reduce rates. Inflation continues to shoot through the Fed's target of 2%. Now, how does this affect us? Well, the rate hikes by the Fed impact the interest rates set by banks on consumer products such as high-yield savings accounts, certificates of deposit, and credit cards. If the federal rate drops this year, this would mean interest on your mortgages, auto mortgages, and credit cards would follow. But it would be better to navigate your credit score and finances wisely now than to hope for fair and transparent monetary policies. Speaking of which, the wormhole of debt that the government has is not going to be solved through conventional policies like radical austerity measures or increased taxation. in case you were wondering. Why? Because recessions are on the whole difficult to predict and calculate. It's important to remain objective when times of economic and political uncertainty loom nearby. So we have to realize that the Fed offers us both assurance and uncertainty. It has the means to guide the economy in the correct direction, but to do so, it must accurately predict the future. After all, core PCE inflation over the past half of the fiscal year has averaged 1.9% at an annualized rate, when previously it was predicted that unemployment and consumer power would take a nosedive. As it is, unemployment in the U.S. stands at 3.7% at the moment, which is indicative of some progress at least. But the point is, not all is set in stone. But that doesn't mean that all's well. Of course, consumer spending has taken a big hit, with personal consumption, the primary engine of the U.S. economy, increasing by a mere annualized rate of a measly 0.8% during the April to June period, which is the slowest it has ever seen. This points us to a possible consumer-driven recession, compounded by high debt levels, consumer loan defaults such as student loans, and job market indicators. Speaking of consumer loan defaults, and bankruptcies are already being observed as we speak. The final quarter of 2023 saw multiple commercial banks note about 2.62% of consumer loans at commercial banks in the United States were delinquent. Although the default rate dropped after the first quarter of 2020 to 2.47% after the pandemic, it started increasing again from 2021 onward and continues to increase. Even the S&P Global Ratings Credit Research and Insights expects there to be a peak of 4.75% by December 2024, from 4.5% in December 2023, with increased defaults, more distressed exchanges, and greater reliance on consumer-driven sectors, or those with vulnerable cash flow and substantial debt like healthcare. Moving on to one of the central factors that could contribute to the recession, the bane of America's economy, the real estate and housing industry. An intergenerational dilemma could spark a crash in this sector. Demographic shifts with baby boomers downsizing and disillusionment among Airbnb entrepreneurs. As the baby boomer generation ages, many are expected to downsize their homes, and because of the massive size of this demographic, which is nearly 72 million boomers, if all of them decide to downsize simultaneously, it could very well trigger a collapse of the already volatile housing market. This increase in homes being put up for sale would disturb the intricate balance between how many homes are available and how many people want, or more importantly, can buy them. And if we come to the millennial demographic at the end of this economic tightrope, they are dejected by the returns on their Airbnb investments, which aren't as glamorous or lucrative as it was marketed to them. AirDNA reported that from about 1 million short-term rental properties, a 3% decrease in revenue per listing was recorded. This puts them in a financially vulnerable position as they grapple to meet their financial obligations. Let us know in the comments below if you think these factors could be big enough to impact the housing market or not. As of the moment, the U.S. Congress is struggling to put its finger on a solid number to allocate for the spending for the current year. There's also a governmental disconnect between the Labor and the Republican parties, respectively. This can intensify the task of effectively addressing the longer-term debt crisis. Currently, the Congressional Budget Office's CBO 30-year budget projections forecast soaring debt, deficits, and interest prices. Annual expenditure is forecasted to shoot from over $6 trillion to $23 trillion in the next 3 decades. If fiscal policy adjustments are not made, the national debt bubble is expected to balloon by $113 trillion, reaching 166% of the gross domestic product, GDP, by the end of 2054. To put this into perspective, at the moment, the federal public debt, which represents the debt borrowed from credit markets, currently stands at 99% of the country's annual GDP, amounting to roughly $103,000 for every individual in America. Is that not outrageous to even fathom? The fiscal imbalance not only constrains spending on vital national needs and goals, but also jeopardizes economic resilience by displacing private investment and government expenditure. On the other hand, central banks are stuck in a vicious loop of debt monetization, continually printing money to purchase government bonds, diminishing the value of native currencies. So, what does the future hold for us? Well, one thing's for sure. The debt crisis is as real as it gets, and we can't just sweep it under the rug until we no longer can. To To avert potential bankruptcies, defaults, and economic stagnation, some experts propose the possibility of a currency reset. This entails recalibrating our monetary system to mitigate the risk of widespread financial turmoil, very much like a financial reset button. The idea of a currency reset, however, doesn't exist in a vacuum without its practicalities and potential pitfalls. It raises various questions about implementation, unprecedented consequences, mutual international cooperation, and the stability of global financial markets. The debt crisis is a deeply layered and taxing, pun intended, problem that has been decades in the making and will continue to exist in the ones coming. The only through this seems to be forward, with careful steps to protect the country and the people living in it. What do you guys think? Make sure to leave your thoughts, questions, and predictions with us in the comments below. And while you're at it, make sure to like and subscribe.